everyone. Good afternoon. We'll start our lesson 3. Today lesson will go through LO3, learning outcome 3. As you know me, my name is Anjum Sattar. If you have any question, please drop me email anjum@university.co.uk. During our previous lesson, we learned about investment appraisal. We discussed about NPV, which is mean net present value. We said if NPV is a positive, we accept the project. If NPV is a negative, we reject the project. Okay, then we discuss about payback period. So we'll start. We'll do a bit recap what we learned during our previous lesson. Okay. So we discuss about NPV. I'm just writing here for the sake of NPV. So net present value. Hello, welcome.
Hello, sir. How are you, sir? Fine.
I'm okay. How are you keeping? You okay?
Yes, sir. Fine, fine. Thank you, sir.
How's weather?
Why it's too hot now? This is already summer
Okay.
season, right? Too hot in Dubai.
Yes, you're right. Here is, okay. Today it's around 22, 23.
Oh, nice weather, nice weather. 22, 23. Not so hot, not so cold.
Yes, but we expecting next week will be cold spell will be back. Huh?
Yeah.
Okay, so today we'll go through our LO3 learning outcome 3. Until now, we had this discussion about NPV. We went through payback period. Yes, we had a discussion about PPP, which is mean payback period. Yes,
Yeah.
we discuss about ARR. Yes, so shorter payback period is a better. We had a discussion about ARR, which is our accounting rate of return, our average rate of return, which we want. Uh, so higher is a better, shorter is a better, NPV positive is a better. Then we had a discussion IAR, internal rate of return. We discussed about weighted average cost of capital. We had a discussion about various other, investment capital budgeting. And today lesson key focus will be, which we'll go through, is our learning outcome 3, which is more about financing and long-term finance. Yes, so if you want to borrow money long-term, there are two ways to borrow money. We can do the debt financing and equity financing. Debt is a better than equity, which we had some discussion, because debt will waive off the interest rate, and the interest rate, which finance cost as is expense, allowable expense, and we can save on the tax. So make recommendation of management if debt finance and equity finance. So debt is cheaper than equity, and we prefer to go for the debt financing than equity. But of course, we had a discussion. We need to be keep in mind the gearing ratio. We need a balance. If you can't afford it to pay back debt, it's easily we can go in liquidation, and ultimately we not sustainable. So use the dividend evaluation model to determine the share price and the cost of capital, and evaluate the usefulness of capital asset pricing model, which we look here. So today we'll make a recommendation on debt and equity management. So which we look debt and equity. Yeah? Okay, so sorry, it's not moving. Okay, so we can look around the sources of finance. So we can, if you want to finance things, so you can think about, always look around the purpose, look around the cost, look around the benefit, and then you decide, which one is the best source of finance for you. Because end of the day, we want to make sure we achieve the key objective of the finance. Why we borrowing the money? What is the purpose of the finance? So the debt is the better than equity, which we mentioned, but of course we look the gearing ratio, what our impact will be. We can lease or we can buy. We can look around the long term, maybe we can risk and return, we can look around. We can look around the different Islamic finance, Modarba and Mazarka. That's, which is no profit, no loss really, but we, the type of, then the asset and the title of the asset, those we can look around the venture capital. Okay, then optimum capital structure. Remember the graph of the cost versus the gearing. The static state theory, the firm stable the position will adjust their current level of gearing to achieve the target level. And we can look around pecking order theory, which is firms prefer to be hierarchy of financing. The C in which we can look around, the which one is the best for you. Okay, so when we looking why we choose the debt financing, in the long run, debt is cheaper than equity. That give the tax benefit. Lender not really going to tell you how to run your business. You have to run yourself. Look around different stream of the revenue where we can generate. So that's why we say don't put all egg in one basket. Look the various options to maximize your return. And that's we need to be more time to be actually run your company. And we need to be look around the steady perspective, not the short-term perspective. We mean the long term. Why choose equity financing? No interest payment, no liability, no monthly payment, operational experience in the case of P ratio, profitability to equity ratio, the cost and venture capital, and follow up the funding. So we can show financing when we looking the best, the capital structure of the business is the capital structure that minimize the weighted average cost of capital. So that's really we need to be crucial. We have to minimize the weighted average cost of capital. If the weighted average cost of capital is a higher, so no point, so it should go down. You have to look around the average cost of debt average cost. So your debt and equity finance. So it's go down and then it's go up. So we need to be look around where that level of debt to equity can be best. If it's more than that, of course, this can be a huge impact on business. So we have to look around key consideration, the flotation cost of issue debt and issue equity. Those we need to be. Interest rate really matters. So if the base interest rate is quite low, so the cost of the debt can be for the issue equity interest rate. Issue equity is a high if low issue debt. Tax rate is a high tax rate issue equity and low is issue debt. And we can look around earning volatility, how volatile the market issue equity if the high issue debt. So we can look around the pros and cons of business growth. We can look around the percentage of the debt in the capital structure, issue equity if it's a high debt, issue debt if it's a high equity. So equity, the percentage and the debt other way around. So we need to be look around these all possible options and current, and then you can decide which option you want to go. Okay, so we can look around lots of examples. I'll quickly show you that equity finance, and we can say Kaplan. Kaplan is, of course, you all know we had a discussion. So Kaplan is the publisher, and we can find the chapter of the book. Debt financing, that is a main alternative of equity. We can look around different point of view. Yes, so these are all the debt financing. Yes, so each of its own advantages and disadvantages, and we can look around the equity financing. Yes, so we can issue shares and share value, what will be happen and impact existing shareholders are registered capital. So that's we can look around. And so please, it's good to be capital structure, the sources of finance, how this will impact us. So these we can keep in mind, and it's good to look around cost of debt, cost of equity, which we had a discussion in the previous one of lessons as well. So it's good to look around. Okay, so that's we can move to 3.2, which is use the dividend evaluation model to determine the share price and the cost. So dividend evaluation model state, the value of the shares can be estimated at the present value of the future dividend discounted at the share required return. To calculate the shareholder required return, the cost of the equity, we backward the PV. PV is the present value of the discounted. So cost of equity and cost of the share price and the future expectation regarding, we can reduce the cost. So the dividend evaluation model, which we can DVM as you,
Sir,
yes,
sir, in the debt financing, we don't here discuss about the bond financing. That there is the two crucial thing. There is equity financing, and some companies are preferable to bond financing because normally they took from the loan from the bank or some other third parties. They
bond is
prefer the issue the bond.
yes, bond is a long-term debt which come under
Yes,
the debt financing, which is a commitment. It can be secure, but think about the principal amount. You need to look around the coupon rate. You have to look around the maturity rate. Yes.
yes, yes, yes. There is a
So
lot of bonds is there also.
yeah. So there is called junk bond in states. So junk bond, those are the very low rating companies. Their ratings start from triple C plus plus D plus plus. Yeah. Those
Mm.
are low rating companies. There is a high risk. We expect the high bond rate there. Yes, and these can be sold in, and these are companies. But normally, good rating company, their bond and the principal and the maturity rate, those depends on what purposes you want. Huh? So they normally interest rate or the return can be lower. Huh? So these are number of factors which we need to keep in mind, and that's a huge impact.
In assignment, there is I think discuss about the budgeting, budget and the variances discussed. But in our lecture sheet, and you didn't discuss about the budget here in this subject. Before other subject you can do, but
Hmm.
here I think little bit of some knowledge you can give to the budget and variance,
Yes, sure,
so student can understand. Yeah. Because we need to prepare the budget about the budget and variances and discuss the impact of this.
sure, which we can look around because budgeting, are called budgetary control, huh? Budget and the variance. Variance have two types, when we look the budget is the financial plan for future. Huh? So there is two types of different types of budget. Budget is the financial plan for future. We can look around the planning, control, qualification, coordination, yes, evaluation, yes. During our assignment discussion, I'll include more on the variance as well. So variance can be material variance. Material can be two sub variances. Material cost variance is consist of material price variance and material usage variance. Yes. So when the maybe the price wise you save on the material because you bought from China and the prices are low, but maybe the material is a waste a lot and the usage variance can be adverse and the price variance will be favorable. And but when you look the overall the cost variance, maybe it's in your favor or it's against. Yeah. So always you look overall the cost variance, not just only the price and the usage variance. Okay. In term of the labor cost variance can be labor rate variance. If you're paying high rate labor, maybe the variance is adverse. When we look the efficiency of the labor, maybe they give you more productivity. And overall, if you look, that can be in your favor. So that's your material cost variance and labor price rate variance. These are two important variants. Then you have a different overhead variant. We can look around fixed overhead variance. We can look around capacity variance. We can look around efficiency variance. These are all overhead variances we can look around as well. Variance, why is the variance? Variance is the difference between budgeted and actual. It due to the standard, because the standard is not appropriate. Yes. So we can look around budget and variance, and we have different variances. Okay, so variance analysis is very important tool in which we can use it to calculate, and decide. So in the sales, these are all the formulas, and I'll give you the formula sheet separately, and we can calculate these variances, and we can find the causes of the variance why we have, in our assignment. We can look around the budget. Budget is the financial plan for future. Budget help, set NAF. We have a different types of budget. Zero based budget, we can look around different other budget, like, it's a fixed budget, flex budget. These are all the budgeting we can use it for the future planning purposes, okay. So in our next lesson, I'll add, some budgeting elements further to further, because the assignment criteria slightly changed this time because they issue the new assignments, okay. So but for the budget also linked with the debt and equity, because, end of the day, where the money coming from. Yes, those we need to be look around. Any question here, After?
I understand already. I understand the budget and variance. I do already. I submit my assignment already there, and I got the distance. So I think you know that I already sent to you.
Okay, good. You already submitted. Okay, great.
Yeah.
Okay, brilliant. So we can look around DVM, which is dividend evaluation model. That's also we can use the formulas. Of course, P naught is the estimated grant. We can look around the dividend. We can look around the growth. We can look around the return, and then we can uh, rearrange the equation, and we can calculate, dividend. So dividend evaluation model, K is the cost of equity divided by dividend divided by the P naught with the price of shares now, and we can find the growth of the price of the share. So two ways to estimate the growth rate and the past dividend, and we can based on the past pattern and earning retention model, which we can look around different models under Gordon growth model are the risk, market risk model. And according to this, we can measure it. So according to the growth model, we can say this formula, we can use it. The growth model, D naught is dividend now, and we can look around the dividend in a years ago and how much is the growth. So N represent the number of years that the dividend growth. The model can be used, and recent, the dividend pattern is considered typically historical pattern for the future, and we can estimate, the earning and retentions. So higher level of retention in the business and a higher level of potential rates, which we can look around. So G is the growth is equal to B and our post tax accounting rate of return earned and the reinvest, the fund, and B is the earning retention rate, how much we have. Then we can find it, the further, we can calculate R is the rate which we can be based on profit after tax divided by opening, the shareholders fund. So these are all, whichever model we use, always have the pros and cons. Think about which is best for you, is according to your financial situation, according to your budget, which model you want to use it for for analysis, and then you can plan, things accordingly. So as we discuss in the budget, it can be standard, ideal standard for ideal situation. There is a no variance in there. So you have to be, there is a no flexibility. But the current standard is a better to the current environment and the current, then you can set the standard and the variance accordingly. So the current market price subject to the short-term influence at the market movement. Consider the this then estimate, the cost of equity. We can look around the future dividend, the growth rate, constant growth rate, the no guarantee of the dividend in future. Maybe, of course, cost of equity calculation can be impacted. So we can look around the relevance of the earning don't, the features at the DVM, dividend valuation model, and we can look around the earnings should be indicator for the company long-term ability to pay dividend. So we can look around estimated rate of the growth of the dividend. If the company have the future plan of the contract being awarded, that can be huge impact. So 3.1, we can look around the use of capital asset pricing model, which is the KE equal to RE, which is we can look around the return on received by equity investor. RF is the risk-free, beta is the risk factor, RM is the market, and RF is the risk return on the market as a whole. And this by putting the figures and the calculating, we can calculate so risk-free premium, and we can show them the graphs as well, the market return and the risk. If you have a higher the risk, you expect the higher the return, but you have to be minimize the risk and maximize the return if you investing in different shares, where average cost of capital can be down and the profit can be go up, at the dividend growth rate. Using of the capital asset pricing model, we can look around the security comparison. Investor use capital asset pricing model in different security to contrast the rate. Portfolio, don't put all egg in one basket. It mean investing in different shares. Modern portfolio theory to choose, suitable investors. Capital asset pricing model is the portfolio asset allocation. Can be using the capital asset pricing, intrinsic value. Investor and analyst use, capital asset pricing model to evaluate the book value and the market value, and asset is considered to be good to deal the trading lower the intrinsic value. And we can look around the NPV, net present value method is considering higher the NPV, real value of the money. We can look around judge the investment project, diverse, the kind of the risk attached, the risk need to be minimized better than the dividend evaluation method explicit, which we can consider the level of the systematic risk, unsystematic risk, and the superior weighted average cost of capital is providing the discounted rate is useful for that appraisal purposes. Of course, we can look around the dividend discount or NPV discount rate. When you increase the discount rate, ultimately what will be happen, NPV will drop, so it can become, so if you need IAR, so you need positive and negative NPV to calculate. So what we'll do in our assignment discussion session, so you already submitted a stuff, but those are attend just listening this recording. In the next lesson, we'll do assignment discussion and we'll go through all the contents and we'll recap, on and how we can meet all the learning outcome within our assignment brief. So of course, variance is very important, which we look the budget and the budgeting and the types of budget and the budgetary control. So that if you're really keen to learn more about the variance and types of variance, I can give you the separate handout just on the variance. And if you want to look around the budget and the budgetary control and types of budget, fixed budget, flex budget, zero-based budget. So these, we can look around more in detail. But other than that, if you want budget or budgetary control, so please you can just say budget and budgetary control, Kaplan or variance and Kaplan or the causes of the variance. So that's also available resource. So basically under the financial management control and the financial management, we can look around the financial management. Management is the internal. So financial management, which is part of the management accounting. So normally we use the budgeting, we use the investment appraisal, and we use the financial management side, which it means finance, sources of finance, how effectively we manage, So these are the key areas we look, then we have a trading management, we have the risk management, we have these are all, which we are the portfolio management, which we can look around. These also part of, management accounting as well. Okay, so that's
So
all.
I can say I think budget and budgetary control and variances we can find in the financial management and control. These books we can find that one very clearly. And if you have the clear notes, hand notes, you can send us to the email or add in the nodules so we can find it.
Yes, sure, because There are the two subject is quite, the unit content being planned. Huh? So one is a financial management and one is a financial management control. Yes, so which is control, of course, where we're looking how effectively imply these. Yes, so no problem. What I'll do, I'll embed more and we can go through accordingly. Yes, Aftab, any other question?
So another thing is that this deviation, dividend valuation model this dividend how to calculate. There is a this non what is called that one. This one stage is that there is a lot of this over two stage, three stage, all the H model. This non-constant growth of dividend. This type of model. This means you need to determine there is no growth is not fixed. Also, interest rate is not fixed. That I'm talking the IRR is not fixed and growth is not fixed. That's time you have to do the two stages of growth model and the three stage. And other than these two or three is not in there, you also do this H model about that one. So there is an equation. When I calculate the dividend present value, there is what is called summations. The how I calculate that one, I need to know about that. You can go through this. We have this um, uh, dividend valuation model. You send the sheet that one. This is the case study. You submit it with the noodles. I find it and I just know how to calculate that one.
Mhm. So normally, in the light of the data we collect, and then in the light of the formulas we apply, of course, different models which we can. I'll just show you, and you can uh, do, because we use it FM, which is financial management of ACC as well. The same models, yes. So hope you can see. So what you can do, if you want to look around for, and I can send you separate handout for this. Huh? Okay, so
Okay.
we look within this FM, financial management. Are you on open tuition?
Yeah, but I know I already do it.
Okay, so great, well done. So what we can do, we can look around and I can go to advanced levels, which is, so if we look here, we've been given like here. So you will see there, these are all the sections, yeah?
Mm-hmm.
Whichever you looking, weightage average cost of capital, risk, you want to explore about, yes? So like here, you can weightage average, cost of capital, we had, you want to look around the dividend. Huh? So if you do control F, dividend, yes. So you can look around dividend return, yes. We have, increased dividends, yes. So these
Yes.
are
Okay.
different examples we can pick because all these are appraisal different tools, we can look around and we can use it. So I can give you F9 or yes, because the tax element there or without tax element, yes, and the growth and growth rate model. So which we can look around DVM growth. You will see there is dividend growth model. Yes, R equal to
Yes.
D plus G. So we've been given here some examples. Yeah.
Mm-hmm.
So we can find, the price, the dividend we expecting the next year. We can look around the previous years, what the growth rate we have, the dividend we paid, yes, per share. If we have the company policy giving the free shares or the bonus shares, yeah, these can be huge impact, on the growth. Yes, because the dividend, it means the return earning, the earning we have, we divide on to the more shareholders. Yes, because you're giving the free shares to your workers. It can be impact on the existing shareholders and the growth rate as well. Huh? So that's, which we can look around. These all the factors we can consider before, we can make the decision. So you will see here few examples as well. Okay, so
Okay.
we can go through. So you will see all the data then. Yes, return earning. So return earning, what it mean? The return earning, the earning we are returning after, yes, and the dividend we paying, what percentage of the because never we as a company we never pay all the money to the shareholders, because otherwise maybe 1 year we have a loss, yes, 1 year we have a profit. Ultimately this is carry on happening. So we want to be consistent dividend growth, dividend policies in place. So maybe you have a multi-million profit 1 year and the next year you have a loss, yes.
Yeah, yes, sir. Yeah, maybe it's happened. So it will go to the, you can keep it in the return earnings. So if it is the worst situation in the company, we can distribute it again
So
the undergoing circumstances.
we have a consistent growth policy of the dividend, not giving
Yes.
huge 1 year and decline next year. Because otherwise the sentiment of the shareholders and their trust will drop. Huh?
Yes.
So they expect, something they will get it out of. And we're not bound even to pay the dividend to shareholders. Yes. According.
Some company also do like that. But if your company will be the, in the IPO,
Yes.
the financial market, so you need to give some dividend every year. So people, your share value will be increasing. That
Yes.
is the most
Amazon
of the companies do like that.
first 5 years, 7 years, they not paid the dividend to the shareholder. They said this is the incubator, you're putting the chick and chick will grow and you will get higher dividend, because the share prices was growing, but the dividend they not used to pay. Actually, the shareholders is gaining if they want to sell the shares in the open market, they can earn the money, but they're not used to pay the dividend, but eventually they carry on paying the dividend. Yes, because of course,
Yes.
the company profit went up. So that's all today, and we can further explore. Yes, any question we can, even other than these lessons, we can look around as well, and we can clear the concept. And have a lovely weekend. And next lesson we'll go through the assignment discussion.
Okay, sir. Thank you, sir. Thank you very much.
Have a good week. Thank you. Bye bye.
Bye bye.